This right here, this line here, that's also called pain. That was in 2008. And now it has bounced up off the bottom. In December of last year, I told my clients, this sounds so hokey, but it's the truth, so I got to tell it. Okay? You can go back and look at my newsletters. I said, the market is probably going to bottom in March, and we're going to have a V-shaped recovery. Now, the only mistake I made was not following that advice explicitly. But I did say that's where I thought it was going to go. The reason I did not jump in March, and I wish I had, was I felt there was too much risk on the table of a correction. The fundamentals were worrying me. All of a sudden, fundamentals don't matter anymore because every time there's a fundamental issue, the government pumps another $1 trillion into whatever the fundamental was. So since we got the government picking up the tab for all risk, we have to change the way we look at the market. And I don't care whether you're a Democrat or a Republican, liberal or conservative, independent. I don't care. Actually, I do care, but I'm not going to get into that. The point of it is, we all have the same need, and that's to make money in the market. And you can only do that if the rules fit and that you can depend on them. The government has changed the rules. You've got to be ready to go with those changes. Now, here is my crossover oscillator, and I've got about 2 minutes left. This is the market over the past 3 years, a little less. And this little squiggly red and black line, which I do not have time to go into the detail of it on, but there's something wrong there, is that this is the number of new short sell signals, the red line is, and the black line is the number of new buy signals less the number of new short sell signals. It just so happens that in this crossover, 5 minutes, thank you, just in this crossover oscillator, every time these two lines cross over, hence the name, the market tops, and a correction or near correction ensues shortly thereafter. Every time. So, at these dates, let's just go back and look at the March to May time frame of 2008. When you're just before crossing that red line is some of the most bullish times you can be in the market. Because what is happening is this, and this is counterintuitive, but what's happening is that the market is becoming overbought. And latecomers to the market are wanting to jump in. They're afraid they're going to miss out. You get almost into a state of panic buying, and you can make a lot of money in that period of time. And those will last from 2 to 3 to 4 weeks at a time. I'm not saying you're out of the market the rest of the time, but when that event occurs, you back up the truck. You load it up. Okay? Now, when that red line, when that black line crosses back below the red line, that means that a correction is forecasted as maybe not imminent, but pretty close. Now, here's what I have done in the past. I'm going to show you what I'm doing right now in just a minute. When those two lines cross going down, when that black line crosses that red line going down, I start raising my stops up really tight. And a lot of times the market will continue to shoot higher. And I'll stair-step up. Sometimes I'll change my stops 2 or 3 or 4 times a week, sometimes 2 or 3 times a day as it's moving higher and higher and higher because I'm chasing that over-exuberance, irrational exuberance. Wonderful times to be in the market. Well, how do you know when that's going to happen? This chart tells you. So here was the May of 2008. It recommended normal stops move to very bullish stance in about the April 15th time frame. On May 15th, it said tighten stops and move to very bearish stance. If you had done that May 15th of 2008, you would have a lot more money to be trading in the market today than you have now. Very few people, and if you're one of them, you're to be congratulated. Very few people did not lose a lot of money in 2008. Okay? More recently, April 7th, the recommendation was normal stops move to very bullish stance, right in here. June 15th, the recommendation is tighten stops and move to very bearish stance. Okay, now, we didn't have a big time correction. It did pull back some because you never know when you're going to have a correction that turns into what happened in 2008 or it's only going to go down 5 or 6%. But remember, one of the rules is it's never wrong to take a profit. You were just making a lot of money before. Now here we are. Right now, started 3 weeks ago. We're right there. August 1, my system said, back up the truck. You got people out here saying, we're in the middle of a correction. Maybe. Mine isn't telling me that. So I'm buying, and I want to be long. How long? Don't know yet. The data I've got, and I don't have time to get into it, but I have really two sources of data. One's from a think tank. It's a cycle data. And it says that we're going to have a probability that we move higher between now and December. And then next year we could fall off a cliff. That's always next year. Okay? But you do want to watch that sort of thing, and you need to be ready to go to cash. All right. So, in December, this is where the rubber meets the road. Okay? Okay. In December, I said, here are the stocks that I think have the least resistance to doubling in 2009. Here's the return. These are not cherry-picked. This is 100% of the stocks that I forecasted in December of 2009. Stocks and ETFs. And that's their average gain since the March lows. Okay? How did I get that? The tool I showed you. Okay, so we're done. We've already had questions at the beginning. If you want more details on what I've been talking about, go to booth 116. Remember, this is all going to be posted on the Money Show website and on Turner Trends in a couple of weeks, and on StreetAuthority.com, by the way, StreetAuthority.com. If you want to copy my book, I will be doing a signing at 10:30 tomorrow. And if you want to talk to me one-on-one, go by the booth and set up a time to talk. Thank you very much, folks.